By maxing this 24% earlier in their lifetime, what we've done, Logan, is we've sheltered these assets from taxation. We paid it at an affordable rate. We protected the assets and income levels from getting us into these higher levels of Medicare. Just simply by taking this path early, before even retirement begins, we're showing that we leave $13.9 million in ending assets behind versus, with no tax planning built into the plan, $10.9 million going to the children, for an additional savings to the Longview's family, the family estate, of $3 million of tax savings that we've generated just simply by looking at this conversion strategy.
Welcome to Modern Money Moves. I'm your host, Logan DeGraeve, alongside Corey Hulstein, CPA. Corey, how's it going?
Good. Thanks for having me, Logan.
Absolutely. Well, today we're really going to take a deep dive into the Longview's tax situation, specifically on Roth conversions. If you missed it, you can find our show where we go through Buck and Joy's situation at a high-level view, and it'll really set the stage for why we're having this specific tax conversation today. So we're going to look at the Longviews again at a glance quickly. We're going to talk about the tax planning. What are the hidden opportunities that they haven't taken advantage of? The 5-year window for conversions, the Roth conversion ladder, and then what are the other outcomes of us and the guardrails we need to put in place? So we're going to talk about all these tax moves today and actually quantify for you the difference in these tax planning savings. So Corey, why don't you set the stage for everyone if they didn't see our initial episode of who the Longviews are?
Yeah, so today, Logan, we're working with Joy and Buck Longview. Joy being 58, she's a business owner. She is looking to sell her business here in the next few years. Buck is a 54-year-old firefighter. He will be getting some pension income as well as part of their overall plan. They've got 2 adult children, Bill and Ira, and under them, they've got 3 grandchildren, ages 5, 4, and newborn. We're currently planning through the age of 100. We talked through this, Logan, but we want to have this long-term perspective, and my role really comes in, how do we pay as little taxes as possible, not only today, but over the course of their lifetime. So currently, Logan, they have some confidence in their taxes overall. They're probably working with the CPA on the business side of things, but realistically, we're missing some opportunities today.
Yeah, I want to quantify that for folks. So 5, you can see that they're 2 out of 5 on tax today. So 0, what that means is they don't have, to your point, they don't have any confidence. There's no plan. They don't know where to begin. 2 is, we're gaining some confidence. We think we're doing some things the right way, but obviously we're not there. So their top priorities are, they know that they've saved a lot. They've worked really hard, but they're not really sure how to take all the stuff that they've accumulated and actually get that to work in a tax efficient manner, because they have priorities around education, travel. They have a business. Joy has a business that we exit properly and how that fits in. And then ultimately, we're going to talk a little bit about the end of all these moves and how we are going to be able to enhance the value to the estate, but making sure that goes in a tax efficient manner to the people that we care about, which are Bill and Ira and Penny and Golden and Bronze, their children and grandchildren.
Yeah, so to your point, Logan, they've already done the hard part. They've already saved and accumulated and are preparing for this retirement phase of life. So a recap of what they've already done. Joy's business is worth roughly $3 million today. She plans to exit that business in the next few years and will look to sell that business. Outside of the business, they also have accumulated around $2 million. And I want to highlight, they've done a great job at saving to different buckets.
Why does that matter?
Yeah, that creates flexibility for us. Now, Buck is going to retire. The plan is that he's going to retire before 59 and a half. Having funds available that get us to that 59 and a half age period becomes crucial for these people.
And I think one of the other things you're going to see when we're doing Roth conversions, which is really one of the main strategies we're diving into today, the ability to pay the tax from other buckets of money is going to be critical, and we'll highlight that here in a little bit.
Absolutely. So already funded all 3 buckets. They also have a home and property, vehicles. They also have some life insurance with some cash value as well. That, again, will be a different segment for us, but that component does have some tax ramifications as well.
So Corey, before we jump into the strategy here, which you're going to see on this next slide, or focus on the Roth conversion plan, one of the things that we see with the Longviews is, like I said, they've done the hard part. They've saved. They've actually done the even harder part of laying out, which you catch in the first episode, what their goals are, their hopes, goals, dreams, desires. They even have a timeline for travel. In our job, or if a financial advisor's job and the team, is to make sure that they're able to do the things that they want to do. Because at the end of the day, they didn't work just to work, right? They saved with a purpose, and we see that. Now it's our job to figure out how we take the tax burden off of their plate, but it's in a way to give them confidence so they can go do these things, Corey. And we see that a lot with clients. And I think that a lot of people, they do a great job of saving, but they're not confident or free to go actually live the life that they want to do. And that's the point of this. That's the goal of what we're trying to accomplish today.
Absolutely. Unwinding the assets becomes a big priority for me. How do we do that efficiently? There's always going to be an element of taxes, but let's make sure we pay the least amount possible over the lifetime.
So why don't you get into how we do this?
Yeah, so today, Logan, we're going to talk primarily about Roth conversions. Now, the Longviews have a few different pieces going on where we're going to actually capture some different opportunities throughout their retirement with taxes as well. But today, the focus is going to be on Roth conversions. Now, step one for Joy and Buck here is we do need to roll that 401k over to the IRA. 401ks have different sets of rules. They may or may not be eligible to do a Roth conversion inside of the 401k. So the cleanest and easiest way to do this is just first shift that money over to an IRA status. The second...
Is that a taxable event, Corey?
That is not a taxable event, Logan. We're keeping it from a traditional 401k and moving it to a traditional IRA. You'll get a 1099-R, but it is not a taxable event there. The second step in this process, for Joy and Buck, in the first episode, we identified that their long-term tax rates range from 22 to 24% taxation. And again, there's some risk there. Joy and Buck are in their mid to late 50s. Will tax law change on us over the next 40 years? My guess is that very well could happen. So we want to protect ourselves from whatever Congress may do, but we also want to get out in front of the growth. And for Joy and Buck, we've identified that the 24% tax bracket today makes a lot of sense. And so one of the things that we want to do is say, let's opt into taxation at 24%. Take the IRA that we just rolled over and start moving those funds over to the Roth side of the equation here. And to your point, Logan, the key here being they've saved to other forms of accounts. That taxable account becomes very important to us because one of the things that makes the Roth conversion most effective is that we pay the taxes out of that brokerage type account.
One thing too, Corey, I want to highlight, it's not just filling up the 24% tax bracket because that's what the plan tells us. There's also a little bit of a human element to that, and I want to explain that. One of the things that is a risk in this plan today is in the event, God forbid, I'll say Buck were to pass at 65 and Joy lives to 95. That's 30 years or 30-ish years, right? That someone's a single tax filer. What we know is when you go from married filing jointly brackets to single, those get cut in half approximately. So that 24% bracket today looks really, really clean in the event something like that were to happen.
Yeah, we talk about this with our clients frequently, but it's about protecting ourselves from the bad events of life. And unfortunately, that is one of those scenarios we see frequently where one spouse outlives the other for a lengthy period of time. The hidden cost here is that taxes drive up significantly when something like that happens.
Yeah, and the other thing too is we're going to talk about we don't have Medicare implications today, or IRMA.
Yep.
And then ultimately, which we're going to get to here on another slide or two, is Joy's business. How does that fit into all this?
Yeah, so great lead into this, Logan, but Joy is planning to sell the business here in a few years. And again, low cost basis on this business. This is going to be a big taxable event for us when the time comes. So one of the things that we want to do is get this income today out in front of that business sale. So when Joy sells the business tentatively in 2029, that might change our philosophy with this Roth conversion strategy. We might push a pause onto that side of things. But the reality is we want to grab this income at a low rate today. To your point, we're not facing some of the additional costs that come in play when we get to age 63 to 65 with things like Medicare. The business sale is going to have its own unique component to it, we're going to dive into that separately in a different episode.
Well, and we also have a pension we're going to have to worry about too. And one of the things that you just alluded to, we're going to dig into this and how it impacts the overall plan specifically. But we look at that $718,000 of tax due in 2029. We know we have a charitable goal. There's going to be things we're going to talk about, different strategies to try to alleviate that. For today's purpose, it's really on Roth conversions. But this is another reason we're okay with speeding up income in 26, 27, 28, because we know in 29, there's really not going to be anything we can do to speed up income.
Correct. And I'll even highlight that charitable goal here, Logan, because one of the common things I hear from clients is, well, I'm trying to get my IRA balance to zero. And to me, that's a missed opportunity. We don't actually want the IRA to truly get to zero, because at age 70 and a half, that $10,000 donation per year can come directly from the IRA tax-free.
Well, one of the things that I have seen a lot when I work with clients, and you've seen it, is as people step into retirement, we often talk to them about charitable giving. And one of the things that often is said is, well, I just don't know, I'm not gonna have an income. And I always say, well, is it important to you? Yes. Would you like to do it? Yes. So once again, going back to what really matters to people, connecting with what they want to connect with. In this case, I don't know what the charity is, and it's different for everyone, but it's important that we get that into an overall financial plan, because if someone says, yeah, I'd like to give to charity, and you say, well, now we got to trade off between a trip and charity, that's not the goal.
And great on Joy and Buck here to have some of those things already identified, because if their charitable number was $50,000 per year, Logan, this whole scenario looks a lot different for how we draw this up. So what we're talking about here is consistently paying tax at 24% for Joy and Buck. So in the first couple of years, both are still working. We have income coming into the plan. We've got the pension income, we've got wages, and we've got the business income. So the Roth conversion opportunity isn't as significant in the early portions of the plan, but we don't want to miss any type of opportunities. So that ranges from around $137,000 to $150,000 a year in additional income that we want to grab while they're still working. To what we just talked about here, Logan, 2029 is going to be a little bit of a unique year for us. That's when we expect this business sale to come through. We've got it modeled in here that we still plan to pay tax at 24%, but that's an area we'd want to dive in a little deeper. Remember, today is kind of this long-term starting point to say, this is where we generally see things going, but this isn't set it and forget it.
And one of the things too that we haven't highlighted, we did on the initial show, the overview show of the Longviews, is tax rates historically are pretty low. So you look at this and you might say, well, why are we paying tax at 24% when we know we can pay tax, at 12% from 2031 to 2045? Well, one of the reasons we even get into the 12 and 22% tax bracket in these later years of life is because of the work we're doing on the front end, because taxes are a matter of fact. What we do know is we have the playbook to play within today. But Corey, when we look at these income levels, it's not crazy, even if we were to revert back to the old tax system, that they'd be 4 or 5% higher across the board.
Absolutely. So we want to take advantage of these low tax rates while we have them available to us. The reality is tax law is permanent today, but Logan, nothing is permanent in Washington, D.C. So something we want to put a heavy focus on early today. Now again, in 2030, things kind of streamline out for the Longviews. This is again, one last scenario for us to go be aggressive, pay tax at 24%. And I want to highlight ages there. 62 for Joy, that becomes a key number for us because Medicare looks back 2 years. That realistically is my last big conversion opportunity without having that additional cost of Medicare.
That's what we're going to get to here in a second.
Absolutely.
So I think when we look at that, Corey, that is line by line what we're proposing. And we're saying, hey, look, if we do these things, we have some assumptions. How does that actually benefit us and the kids and the grandkids? But one of the things I can tell you too that shouldn't be missed is when we start doing these Roth conversions in 2026, we're getting money into that tax-free bucket. So we're gonna have growth on these assets. And remember, one of the advantages of doing Roth conversions is the Longviews have a long time horizon, God willing, that they're gonna retire, fairly early. And saying that we're going to live to 100. Well, we have a period now in tax-free money that we're going to get all this tax-free growth. Where if we leave it in the tax-deferred bucket, it's still going to grow. It may grow the same, but oh, by the way, the kids and grandkids have to pay taxes on it. So that's another piece. Talk a little bit about that, because I don't want to skip over that. Let's make the assumption that the Longview said, hey, look, if I don't spend my last dollar on my last day, we're going to leave it to the kids and grandkids. Why does this Roth conversion also matter for them?
Yeah, and I'll even take it a step back further, because where I start with everybody, Logan, is let's think about cash flow. Cash flow is easy today while we're working, right? We have enough income to cover our expenses. But when we start looking at that year of 2030, for example, well, now there's no more cash flow coming in the door, and where does that come from? It's going to come from our brokerage account, right? We just got a big influx into that account from the business sale. So we'd like to first send money from that account, keep taxes low, move that money over to the Roth, because to your point, when we look at the brokerage account versus the Roth account, the huge advantage here is that tax-free growth for this long period of time, 30, 40 years. When we think about the wealth transfer piece as well, today, that brokerage account receives what we'd call a step-up in basis, meaning the kids or grandkids, they don't really have any tax bill on that account. But the Roth account also gets this period of 10 years where we can absorb all additional income tax-free out of that account. So a lot of advantages reside in that Roth account.
Yeah, and then let's move on after this. But the same thing is if we didn't do these Roth conversions, it all accumulates in a 401k IRA. We know that their plan's directionally correct. They have enough to do these things. Well, now this legacy, let's just say it was around $15 million with no tax planning, that's going to all be taxed in the IRA bucket, the 401k bucket today, over a 10-year period to the kids and grandkids, most likely in their peak earning years. So let's continue on here.
Yeah, so here's a quick outline of what we just described. Lower conversions in these years where we're still working. We have a lot of income coming into the plan already, but you can see we're taking advantage of these low tax periods when we've retired and really shoving a lot of money over to that Roth account at that time. So what we're showing here is what is the impact of this Roth conversion strategy to the Longviews. And what we're showing is by maxing this 24% earlier in their lifetime, what we've done, Logan, is we've sheltered these assets from taxation. We paid it at an affordable rate. We protected the assets and income levels from getting us into these higher levels of Medicare. Just simply by taking this path early, before even retirement begins, we're showing that we leave $13.9 million in ending assets behind versus with no tax planning built into the plan, $10.9 million going to the children, for an additional savings to the Longview's family, the family estate, of $3 million of tax savings that we've generated just simply by looking at this conversion strategy.
Corey, let's talk about this, because this is something that I think a lot of people miss, and you highlighted it with the 62 point, but Medicare is not free. I think there's a misconception that sometimes, Medicare is part of, it's going to come out of your Social Security benefits if you're on Social Security, which comes into the cash flow conversation, which comes into the tax conversation. So when we're speeding income up in these 5 years, show the math of why.
Yeah, so to your point, Logan, Medicare is not free. Even if we do this, we anticipate that the Medicare premium is still going to be around $6,800 for the Longviews combined on any given year. But really what we're looking to protect ourselves against is those later years where those required minimum distributions get out of hand. We have a lot of money in taxable accounts that generate interest and dividends. That forces our income to go higher. And you can see what those annual Medicare premiums look like for the Longviews had we not tackled some of these issues.
This is a lot of inflation, right? Because we're out to 26. So if you're watching this and you're saying, "Oh my goodness, I'm never going to retire," no, this is 2066.
Yeah, we've got a lot of inflation built in here. We have healthcare inflating at a higher rate than just your cost of goods from the grocery store. But the point here being is protecting the assets today, controlling the income streams for the future, saves us money both on taxation, but also from a health insurance standpoint.
It's not just about the dollars and cents, and I'll talk about real life scenarios, but it's, hey, look, you had this unexpected bill in January. And it's, hey, look, your Medicare premiums are going from the base level to the third or fourth level. Well, Corey, let's assume the extreme scenario. We weren't expecting this. The client wasn't expecting this. Now, the advisor should be. That's why we want to look at tax returns even potentially before they were clients for these type of things. One of the things that you'll see is, well, now my monthly income per person in a couple could be lowered by, $600, $700, $800 a month. So going back to what is our job? Our job is to give people confidence so they can connect and do the things that they want to do. And that happens in the preparation piece we talk about. So you can imagine, you might tell a client they're fine to go take the trip to Italy, or in the Longview's case, they want to go, maybe this year they want to go to Australia. They might not want to because, hey, look, I'm shy $800, $900 a month. What? I'm not going to go spend $30,000 on a trip. It's the mental aspect of getting this right why it's so critical.
Yeah, and to your point of the advisor, the tax person, they should be preparing the client for this. The difficult part about this as well, Logan, is what we did 2 years ago is what spurned the activity. So we might, advise someone that your premium is going to be higher in a couple of years. Well, that's a pretty easy thing to forget over a 2-year period.
One of the things is when we're just looking at flat tax rates today, 24%. If we were into the post-62, let's say that Joy's 64, 65, one of the things that Corey and his team would be showing is what is the shadow tax or the IRMA tax, Medicare tax of doing these Roth conversions? Because it's not just 24%. We're going to see probably 2 or 3%. You've done enough of this.
Yeah, so the reality is for Medicare, it ranges from 4 to 5% of additional cost on the conversion. Depending on where you are, the first bracket being about 4%, the last brackets being around 5 to 6% of additional cost. So that 24% conversion now shifted to 29 or 30%.
That's why we're doing this early.
Correct.
One of the other things that we look at that we haven't talked about is, why do we want to do this? And it's for all the reasons we described, but it's also smaller required minimum distributions. So one of the things that we can't control to some degree is what our IRA or 401k balances are going to be when we hit RMD age. Okay, so what we know is every single year we're going to have to start taking money out of it. So in 2043 and on for the Longviews, every single year the government's going to say, hey, look, we got to take X out of the IRA accounts. Once again, going back to what we just talked about, it's very hard to control the IRMA distributions, the IRMA penalties, those type of things. Leading into the next thing, lower IRMA. We just highlighted that. Less Social Security taxed. We're going to spend a whole show walking through the ins and outs of Social Security, but Corey, hit on this at a high level. What do you mean? My Social Security's taxed?
Yeah, so Social Security is taxable at 0%, 85%, or anywhere in between. So one of the common things we're looking at, Logan, is let's do these conversions early before we turn that Social Security benefit on. Because the way the IRS determines how much of your Social Security is taxable income is it basically looks at all your other forms of income. Roth conversions, IRA distributions. As you take money from there, we pay tax on those accounts. But what happens is it becomes a little bit of a shadow tax where it drives up, where I pay more tax on my Social Security benefit. So what ends up happening for most of our clients is that 12% bracket today, it's a myth. It turns into 22%. So when we look at the Longviews in particular, 22 to 24%, it makes a lot of sense, and it also gives us flexibility on when we want to turn that Social Security benefit on.
Yeah, and I think lastly there is you see that $17.7 million in tax-free legacy. So I want to highlight that roughly $2-3 million, these numbers are moving from our initial show that we're actually generating in assets left to the family, the legacy. And the other thing is too, this is all passing to the kids tax-free because the assumption is we have all the money or most of the money in Roth. Now I know we wouldn't get every dollar out because we have some charitable giving. We have the business that we sold, that taxable account that we're going to assume a step up in basis. So this is...
And I want to hit on something there, Logan, too. With all the clients that we've talked through over the years, how many of our clients say to us, I just want things to be easy for the kids. I don't want the kids to have a burden because of what I gave them, right? This strategy that we've outlined largely accomplishes that. To your point, there might be a little bit of money that's still taxable for the kids, but the simplicity of transferring that money, the kids have complete access, complete freedom of that money when they receive it.
Yeah, so one of the other things that this doesn't even show necessarily is the extra benefit to the Longview family of the kids not paying tax on all that IRA money over a 10-year period. We don't know. In the future years, maybe we'll talk about what the kids' tax rates are and really get into this. So how do you do this right? Because we're making it sound fairly simple. This isn't the most complicated thing, but at the same time too, you have to make sure that you're paying attention to certain things. And what are the certain things we have to pay attention to?
Yeah, so the first thing here, Logan, is make sure we hit our number, right? So when we say we want to pay tax at 24%, if we miss high and start triggering income to be taxed at 32, we failed our job here. So it's pretty simple overall. Let's just make sure we hit the intended target that we were trying to from an income perspective. Step 2 here is pay from those outside accounts. We highlighted this earlier, but the Longviews already have money in a brokerage or taxable type account. Make sure we fund the tax bill from that account. Let's make sure we avoid unintended penalties by paying taxes on time from that account. We might look at a quarterly estimated tax payment system there. Also, keep in mind your capital gains. Capital gains are one of these things that in some ways become this shadow tax. When we're driving income to 24%, we have this unintended consequence of net investment income tax. So let's make sure that the investment philosophy matches with the tax component here to say, let's sell the right positions to generate that cash.
I think one thing too to note is one of the reasons that it's so critical to have a long-term vision with all this is that we're projecting within the plan, the Longview's plan in 2032, 2033, we're going to be in that 0% capital gains rate. So one of the things that we highlighted even on the first overview show was we had a concentrated NVIDIA position. And one of the things is potentially, let's say, we lowered risk, which is something that the financial plan said we should do. Now that might be another great time to tackle that position and the gains on that position, because maybe we shaved it down to 4 or 5%, but with growth over the last 7-8 years, now it's at 7-8% of the portfolio again. So that's another way we want to think about that.
Yeah, and just to reiterate what you said, we prioritized the Roth conversions. We left the NVIDIA position at a comfortable spot, that 5% that you mentioned. But now we've achieved this Roth conversion piece, we have this window of opportunity to continue to grab income at 0% there. And this last one, Logan, this one's critical. We don't want to miss any opportunities. Taxes are a year-by-year conversation, if not multiple times a year.
I want to highlight that. So, like I said, I think we're making, for the video, we're making this sound, it's very simple. This isn't all right, you take this and you're going to convert 131,000 and 143,000. This is every single year we have a long-term plan, but sitting down with the financial advisor and the CPA in the same room, looking at, is this still the route we want to go? Because tax law could change, whatever may change, your life situation may change, potentially health. For instance, if one of the Longviews had a health condition that came up, we may get even more aggressive because of what I highlighted earlier with being the single tax filer status. So to be clear, this is a year-by-year look with a long-term vision in mind, and the long-term vision of what the Longviews want to accomplish. And that's going to be critical. So Corey, we talked about one piece of the tax planning strategy for the Longviews, and one of the reasons that we focus on Roth conversions is we see when we look at our Modern Confidence score, when the Longviews, when they initially came in, they were at a 2 out of 5 on tax. And our job is to sit down and figure out how we can give them more confidence in this area. Because one of the things, Corey, that we see a lot of times is they have these goals. It's not, the issue with the Longviews isn't saying, all right, what do you want to do? What do you want your retirement to look like? Do you want to give to the kids? Do you want to help with education? That's not their problem. Their problem is getting a connective plan with tax and investments and financial planning and estate planning. We highlighted a few of these other issues in the first episode. But now what we would do is say, hey, look, Buck and Joy, we haven't fixed everything. We haven't accomplished everything. But the long-term tax plan that we put in place, how do you feel about your tax situation today? And we would like to see that 2 out of 5 go up, which is going to improve the overall score.
Yeah, absolutely. It's about gaining some understanding, but really, Logan, I want to match their goals to the overall plan, right? And so what I say to people is Job one is to listen, job two is discern. And so Joy and Buck have outlined all these different things they want to accomplish within their retirement life. My job there is to map this out for them and say, hey, here's where these things go. And through that, we'd like to gain confidence.
And one of the other things, Corey, is it's going back to the Longviews once we've laid out this plan. Because this isn't what the Longviews, maybe this isn't what they like to do or like to spend time on. That's why they've hired someone like ourselves. But do they actually understand what we're doing and why? Because you can have the best strategy in the world with taxes, and you and I have seen this a lot of times with clients. Hey, look, why am I paying this much in taxes? I don't want to keep doing this. I don't understand it. So if we don't go back to the Longviews and make sure that we actually gain confidence in the planning, we didn't accomplish anything. And I think that that's critical. The reason we do the Modern Confidence Score when we sit down with folks, especially new folks, is to focus on the financial anxieties that many people have and figuring out what are the moves and pieces that we need to make to start gaining confidence in certain areas. If this sounds like you or an area that you need more confidence in, please reach out to us. We'd love to deliver a Modern Confidence Score to you. Corey, thanks for joining us again on Modern Money Moves. Appreciate your time today.
Yeah, thanks for having me, Logan.
I'm Logan DeGraeve, your host. Please like, share, and subscribe. We'll see you next time.
Bye.